Welcome everybody to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. Okay guys, so today I want to cover like 7 different things, all right? But we got to cover the news first. Now look, obviously the thumbnail was very clickbaity, but I promise you it's actually very accurate on what we're going to be talking about today. And the reason I want to talk about insurance or Ponzi schemes or any of that is just because I got into an argument with someone on LinkedIn the other day. And guys, I find myself in these LinkedIn battles constantly. If you're on LinkedIn and you spend 2 minutes there, you realize it's just people it's just Facebook, but people are selling stuff and they're trying to be professional, right? I own my own business. We do this. I'm pretty much in charge of all the investments here. I don't answer to anybody. I don't have to have this professional fake courtesy that other people do on LinkedIn. And I find myself just getting invigorated, furious, angry, malicious. I don't even know, because these people are selling, a lot of them are insurance people. They're trying to sell these bad products, this bad insurance investment vehicle to people, to hardworking professionals. I can't stand it. It bothers me so much. So today we're going to talk about the Ponzi scheme that is the insurance industry. And is it really a Ponzi scheme? I'm going to explain to you the systems of a Ponzi scheme and then the systems of the insurance world. And you're going to get a behind the curtain scene, all right? And you guys know, even insurance agents, the financial planners who sell insurance, don't know about what we're going to talk about today. It's not a commonly known thing. And I want you to be able to know it, understand it, and you'll be able to catch people who are just trying to rip you off and take your money. Or like the thumbnail says, just trying to burn your money away from you. Okay, let's cover the news and term of the day today. So term of the day is going to be froth. Not really anything we're talking about today, but I really wanted to talk about it because the last time we talked about the bubble, and froth has to do with it. So in investing, in portfolio design, froth is referring to, well, let me read the definition first from Investopedia. Froth refers to market conditions preceding an actual market bubble, where asset prices become detached from their underlying intrinsic value as demand for those assets drive their prices to unsustainable levels. Okay, so there are quite a few analysts and speaking heads and figures in the industry that are saying that there's a bunch of froth going on. These AI companies, these tech companies, they're way overvalued. All of it's froth. When you hear froth, I just want you to think about like when you pour a soda way too fast and all of that foam comes up to the top and sometimes overflows and spills. That's what they mean by froth, is it's not actually the substantial liquid or the substantial soda. It's just that froth that shows up at the top that eventually comes back down. And that is kind of what they're referring to here. Froth is a good visual of companies that are way overpriced, overvalued. The only thing I would caution you against when thinking about that is all the stock market, all individual equities, pretty much any investment where people say there's froth, you gotta look at the underlying company. You've gotta look at the future, right? What is the company going to be doing? What is their value? If you're able to do that, you can sift through people saying that there's froth and then actually if it is froth. Okay, let's go to the news so I can jump right into just tackling this insurance stuff. Guys, that LinkedIn fight that I had, I was ready to fight. I really was, because they're ripping off working people and I can't stand it. Okay. So here is the news. U.S. stock indexes fell for a third straight session Thursday as investors digested economic indicators, and Oracle and other technology shares declined again. The tech-heavy NASDAQ and benchmark S&P 500 were down 0.4%, and the blue-chip Dow Jones Industrial Average declined 0.1% around midday. The 3 indexes ended lower for a second consecutive day Wednesday, following 3 straight record high closes. Investors were digesting several economic readings, including the final revision on second quarter GDP, which was revised higher once again, this time to a 3.8% annual growth rate from 3.3%. Weekly jobless claims fell to 218,000 from 232,000 the week before, while August's existing home sales were near flat. The 10-year Treasury yield which affects borrowing costs on a variety of consumer and commercial loans, rose to 4.18% from 4.15% at Wednesday's close after the data was released. Also, guys, just to touch on that real quick, if you have cash, or you have a CD that you're invested in, or a high yield savings account, look into treasuries right now. 4.15% with no state income tax might be better than whatever your high yield savings account is, okay? Technically, you're supposed to pay taxes on that. Do people ever report that? No, unlikely, but it is a great alternative. Okay, tomorrow, the August reading for personal consumption expenditures. If you remember, we talked about PCE. The Federal Reserve's preferred inflation metric will be in focus. Okay, I don't even want to read the rest of this. Let's just talk about this insurance here. Anyway, stock market's down right now. We're going through some, it's the fall. Okay, it's the time where there's not a lot happening except for retail, and now that interest rates have dropped, banks will probably have a little bit of boost in cash flow. So we'll talk more about that another day. Let's talk about this insurance. So I have my notes here. We're going to have an image pop up on the screen for you guys. This is a proprietary visual that I'm going to just have it for me to be able to look at here. How do I even know about this stuff, right? I run a wealth management firm. We invest in companies. We invest people's monies, right? We invest their monies for them. How do we know about this? There's two really big things that separate me from other people in the industry, okay? One, I started in insurance, which I'm not proud to say, but that's the job I got out of college. Okay, I started at a Fortune 500 company, and I can tell you, while I was getting all my license to be able to trade stocks, bonds, mutual funds, all of these things, they were just trying to teach me how to sell insurance. And even then, in my gut, I thought, oh, am I really learning to become a financial advisor? Like, is this really what it is? Even then, when I knew nothing, I knew that it was fraudulent and a scam, and people were they're just money grabbing. Okay, they're just money grabbing. And then second, what we're going to talk about today does encompass some of the higher level designations I have, like the SEMA or the CRPC. Okay, the CRPC is more focused on retirement planning and helping people draft income off of their assets, whereas the SEMA is more a very, very deep dive into alternative investments, derivatives, options, stocks, bonds, pretty much anything in the designing a portfolio, variance, covariance, modern portfolio theory, et cetera, et cetera, et cetera. A whole bunch of stuff. But what we're going to talk about today definitely encompasses alternative investments. And the reason insurance people have no concept of what I'm going to talk about, they've never even heard of this stuff, is because they're not trained on that. And how do I know that? Because I was trained on it. And I know what they're told and what they're taught to be able to sell people like you insurance products. Okay. So I'm using you guys will see a visual pop up here. You'll see policyholder, insurance company, catastrophe bonds, which we're going to call cat bonds from here on out, and then reinsurance funds. Okay. So I want you to put yourself in the policyholder position, retail investor. That's probably you. And if you do sell insurance and you're watching this, I promise you, I'm not dogging you. I'm dogging the industry. I'm dodging the products, because that's all. You're trying to make bread. I get it. You're trying to make money. My encouragement to you is really ask yourself, is this the best thing for the client? All right. And if you're like, I have no idea, reach out to us. I will happily leave a comment, right? Find me on LinkedIn, James Walters, Weston Walters, 77 Financial Group. You'll find that. Our Instagram, 15 Minutes of Finance. There's a whole bunch of places where you can reach out to us. I'm happy to help you. Okay. Become an expert on something. Really provide value. Don't just sell insurance. Okay. So policyholder, insurance company, catastrophe bonds, reinsurance funds. So what you see here is a circle, right? And I call it the circle of Ponzi. All right. It is a Ponzi scheme. So real quick, let me show you or explain Ponzi scheme so you guys can get a grasp of why it's a Ponzi scheme. And a lot of people get Ponzi and pyramid confused. We're going to help with that today. I still get confused. Whenever I talk about it, I go, man, which one is which again? So they're very, very close, but also different. A Ponzi scheme is an investment scam where early investors are paid with the capital of new investors rather than from legitimate profits. While a pyramid scheme is a fraudulent structure that relies on participants paying fees to recruit new members who then pay fees to those who recruited them, with both ultimately depending on a constant influx of new people to survive. Okay, so when you hear pyramid scheme, just think early people get paid the most. All right, so the reason the insurance industry is a Ponzi scheme, and now we're going to refer to this graph here, is because a policyholder will pay an insurance company for insurance. Okay, and there's a massive amounts of types of insurance. You got whole life, universal life, index life, term insurance, which we like. We really like term insurance. And then you have, property and casualty, health insurance, their disability insurance. There are some really, really good ones. And the three I'll touch on that I want our clients to have does depend on their situation. But term insurance, health insurance, and disability insurance for most industries. Those three probably cover your bases. What we're really talking about today is all of the other products that the insurance companies push from their agents. And let me explain how everybody makes money in this. Okay. So policyholder, which this line or this arrow is red. Okay. This arrow is red. That's going to the insurance company. All right. That right there is money leaving the policyholder going to the insurance company. Insurance company says, okay, yeah, if something happens, we'll cover you. The insurance company doesn't actually have all that much money in case this stuff happens, right? If every policyholder came to the insurance company and was like, we need our money, X, Y, and Z happened, the insurance company would just implode. There would be no money for everybody, okay? The way they mitigate that is they offer a CAT bond, a catastrophe bond. Okay, catastrophe can be anything from a hurricane, an earthquake, and to the insurance company can't pay out its debts, can't pay out the policyholders. Okay, so a catastrophe really refers to, is there an issue where the insurance company can't pay out to the policyholders? So they'll issue CAT bonds, all right, catastrophe bonds, meaning they're saying, hey, we will give you a certain amount of interest if you give us a large amount of money. And so the people that invest in these kind of funds are called in these kind of investments, catastrophe bonds, are called reinsurance funds. Okay, reinsurance is just insurance for insurance companies. All right, and stay with me. I hope the visual stays. So you go from policyholder to insurance company. Insurance company offers catastrophe bonds where they get a bunch of money from investors. Right? And then the reinsurance fund, the only reason they would invest in a catastrophe bond is because they're betting the insurance company is going to stay solvent, that they're going to be able to make their payments and make their dues. And the way that they get paid is the insurance company shares premiums with them. All right. So it is a insurance on insurance from policyholders. And this right here, this part of the visual that I really want you to pay attention to is now there's an arrow from policyholder going to, or the policyholder going to reinsurance funds. Okay. Now you'll notice that both of those arrows are red, from the policyholder going to the insurance company and the policyholder going to the reinsurance company. The reason for that is because retail investors like you and big institutions, you can invest in reinsurance funds. Okay, and reinsurance funds invest in catastrophe bonds, which are offered by insurance companies, which get funded by policyholders. So it's just this big circle. It's this big circle of your own money. The retail investors own money. It is unbelievable, and it's fraudulent in the sense of how they explain it to you. Okay. There have been plenty of insurance companies that refuse to pay out when catastrophes happen. They refuse and they just go broke. Okay. A great example of this is just how detailed their contracts are with the policyholders. Those contracts can be hundreds of pages long because in the past they've been sued for X, Y, and Z. And so now they put that in there, and everything is very, very detailed to make sure that if a catastrophe does happen, they're covered. All right. That's why term insurance is way better than any of these investment vehicle products, whole life, universal. They are all, I'm not allowed to say that. Most of the time they are sold and not bought, meaning regular people don't need to buy whole life or universal, right? And this right here, this graph, wherever, I don't know which side it's going to be on. Okay. This visual is real. And what I mean by real is the red arrows, you're sending money to reinsurance funds. You're sending money to the insurance companies. All the other arrows for them are green. Okay, they're green. They're not green for you, right? So why would you trust these insurance salesmen? Again, no offense to you guys. They've been taught that insurance products are investments. They're not investments. They're insurance. Use insurance for what they're for, to protect. Okay, that's why term insurance, you can get $1 million policy. Say you're 30 years old, you're healthy, don't smoke, don't drink, 30 years old, you can get $1 million policy for less than $80 a month. $1 million. Okay, term insurance is the most efficient way to do this. All right, I do think insurance is important, but this graph shows the way they make money off of people. And it's just robbing people. It's robbing them. And when I see people on LinkedIn talking about selling these insurance products, like as if they're great. For example, the guy I got into an argument with, he was talking about how this person he met with had $1 million in a 401k, and how they should have, what they should do with all that is turn that into a universal life insurance policy and link it to an index. And I'm just thinking, dude, on $1 million policy, you would get paid near 6 figures for 5 minutes of paperwork. And that client would now miss out on all of the possible gains that they could have. Almost all of them, because the way those products work, a universal policy, is they link it to some sort of fund. Like usually it's called a sub account, and that has a 1% fee. Okay. And then you're also now capped, right? They'll say, well, you're going to get 4, 5%, 6%. And then you have premiums you have to pay. And those premiums are very, very expensive. And that usually comes out of the investable amount, right? And when you take, there's just so many, there's so many things I could talk about with insurance companies and why their business is faulty. Okay. But you can see how it's a Ponzi scheme with this visual of this circle. The money goes out from policyholders and it almost never goes back in. Okay, I hope this visual helped you guys. Please ask questions. And if you're an insurance agent and you feel offended, dude, talk trash in the comments. I'll respond to you. We'll get into this, because I had to leave. I had to leave the insurance company because what I wanted to do was be an investor, a wealth manager, an actual advisor to people. And they're just salesmen. They just want to sell insurance products. All right. And they're usually sold using fear, which there's no making money when you're scared. There's none. Okay, guys, that's it for today. As always, invest early, invest often. We'll see you next week.